In today's video, I want to zoom out and show you something most people completely missed. Quietly, without headlines, the rules of banking and digital money just shifted. And by the end of this video, you'll understand why stablecoins, banks, and payment networks are now colliding, and why the real power isn't about who owns the money anymore, but who controls how it moves. Think about that for a second. Early in 2026, a small regulatory update from the U.S. Commodity Futures Trading Commission, called Staff Letter 25-40, quietly signaled a major change. It wasn't dramatic. No press conference, no panic. But it clearly showed that traditional finance and digital assets are no longer on separate paths. They're slowly merging. Wow. Here's what changed in simple terms. Clearing systems, the behind-the-scenes plumbing of finance, can now begin using digital assets as collateral alongside traditional instruments. Stablecoins are no longer treated like an experimental side project. They're being folded directly into the core financial infrastructure. Not a forced transition, but a gradual convergence. Let that sink in. Now this is where it gets interesting. As stablecoins gain regulatory legitimacy, the real battle shifts away from coins themselves and toward the rails that move value. Networks suddenly matter more than ever. Compliance, transparency, auditability, all the boring-sounding stuff becomes critical. High speed, reliability, and cross-system interoperability aren't optional anymore. They're required for institutional money. This explains why payment networks capable of handling regulated global flows are suddenly being discussed everywhere, even though regulators never publicly endorse a specific blockchain. The message is subtle but clear. Whoever can move value safely, at scale, and under regulation wins. Wow. Now let's talk about the most sensitive issue of all, stablecoin yield. In simple language, yield just means earning extra money for holding a digital dollar. Sounds harmless, right? But this single issue has triggered a massive behind-the-scenes power struggle. Banks and some policymakers want to ban interest or rewards on stablecoins. Why? Because if people can earn returns on digital dollars, deposits may flow out of traditional banks. Crypto companies argue the opposite, that incentives are necessary for innovation and fair competition. Regulators worry that yield-paying stablecoins could turn issuers into shadow banks without the same safeguards. Everyone is protecting their turf. In everyday terms, it's simple. Banks need deposits to fund loans. Yield-bearing stablecoins attract those deposits away. Policymakers fear sudden deposit flight. Fintech firms see yield as financial freedom. So this debate isn't really about technology. It's about who controls where people store their money and who controls the pipes of the digital economy. Think about that. This unresolved fight has already slowed broader digital asset legislation. No side wants to give up control. And that tension tells us something important. Stablecoins sit directly at the intersection of payments and banking. Whoever wins this debate shapes the future architecture of money itself. Before we continue, quick thank you for being here. If this kind of calm, clear explanation helps you see the bigger picture, a like or share really helps the channel grow. I appreciate you. So, what did Staff Letter 2540 actually change? Originally issued in December 2025, it was a no-action guidance explaining how certain digital assets, including payment stablecoins, could be used in derivatives markets under strict controls. But the February 2026 revision clarified something critical. Federally chartered national trust banks are now explicitly recognized as permitted stablecoin issuers within that framework. That may sound technical, but it's huge. The earlier wording unintentionally left these federally supervised banks out. The update puts them on equal footing with state-regulated issuers. It means compliant, dollar-pegged tokens issued by these institutions can now be used as collateral inside regulated financial plumbing. Quiet, but powerful. National trust banks aren't your everyday retail banks. They focus on custody, asset management, and fiduciary services. By allowing them to issue payment stablecoins, regulators effectively bridge the gap between traditional clearing systems and blockchain settlement rails. Stablecoins are moving from the edge of finance straight into its core. Wow. Does this mean every major bank can suddenly issue a stablecoin? Not exactly. The clarification applies to eligible federally chartered trust banks under specific conditions, but the implication is clear. The legal uncertainty that kept traditional institutions on the sidelines is shrinking fast. Tokenized settlement is no longer theoretical, it's operational. Historically, markets relied on slow, multi-day settlement cycles. Stablecoins enable near-instant settlement. Regulatory recognition compresses that gap. Traditional systems and on-chain systems are no longer opposites. They're converging into a single financial nervous system. Let that sink in. So what's the real takeaway here? This wasn't a sudden revolution or a new law. It was an institutional acknowledgement that stablecoins are becoming embedded inside regulated finance. At the same time, the unresolved yield battle reveals the deeper stakes: control over deposits, payment flows, and the architecture of money itself. As regulatory clarity expands and payment rails mature, the decisive advantage won't belong to those who merely issue digital dollars. It will belong to the systems capable of moving value securely, transparently, and at global scale. Because in the next phase of finance, power doesn't sit in holding money. It sits in controlling how it moves. Wow. Understanding this helps explain why the line between traditional banking infrastructure and blockchain settlement is disappearing so fast. And once you see that, you can't unsee it. Thank you for watching and for your support. We inform, you choose. See you again very soon.